Hello everyone, my name is Daniel Gornall and I'm proud to be presenting to you today on behalf of Mogers Drewett Financial Planning on key financial considerations for 2025, how to future-proof your wealth and financial well-being. So firstly, why does this matter? We feel that financial planning is about adapting and not just reacting. I'll go into that in a bit more detail in the presentation because there's a recurring theme throughout. But firstly, who are Mogers Drewett Financial Planning? Well, myself, I'm a chartered financial planner, and myself and my team have a lot of expertise in working with high net worth individuals and families such as yourselves. Through Mogers Drewett, we're very proud to have a partnership with Wells Cathedral School and be able to show you the showcase the benefit of us having integrated legal and financial services under one roof, which certainly is a unique proposition in this area. In terms of why financial planning matters, as you can see on the slide there's a lot of different facets of financial planning, each relevant to everyone at different stages of their life. But ultimately, financial planning isn't about reacting to headlines. It's about having a structured, flexible strategy that adapts to tax changes, economic shifts, and personal circumstances. So today's talk is looking to cover the key financial issues for 2025 and offer you all practical steps on how to review and refine your financial plan. Really, when we're looking at budgets, it's simply a reminder that it's actually your financial plan that matters. And that's why we call the budget a Trojan horse. So by that, what I mean is the budget is not about certain financial figures, but instead just really serves as a purpose and a reminder to promote structured, objective-driven financial planning. So whilst I won't go into the minutiae and the detail of the recent budgets, what I will do is highlight some key areas that have occurred frequently over previous budgets over the past few years and how it affects individual families such as yourselves. Firstly, I'll go into a bit of detail on fiscal drag. By that, I mean how frozen tax thresholds have eroded wealth over time, the silent tax we call it. There's housekeeping matters, so by that, ways that you can protect your wealth and your family. And then the cash conundrum, which, whilst current cash rates do seem quite attractive, they can give a false sense of security. And I'll show you why in a bit of detail later. So firstly, fiscal drag, which we know is a silent tax increase. Now, what I mean by that is the effect of personal allowances having been frozen for several years now means that inheritance tax thresholds, income tax thresholds, pension tax reliefs, these have all been frozen for years, which actually serves the purpose of eroding wealth over time. You'll be able to see on the bottom graphic there that inheritance tax has been frozen now for years, since 2009, and is actually not set to be reviewed again until 2030. And what that means is more of your wealth is slowly being taxed over time. So even though they introduced there, as you can see, the resident nil rate band in 2016, which was incrementally implemented, still it lags behind what the inheritance tax rate would have been, the nil rate band, had it increased with inflation. So again, another planning matter to take into account. In terms of general housekeeping, it's always an important reminder that your wealth isn't secure without proper legal and financial planning. And that's, again, a benefit of working with Mogers Drewett, having both of those services in-house. In terms of best practice, we do always recommend that wills and lasting powers of attorney are not just established, but kept under review and updated. We also recommend the expression of wish forms are completed for pensions, not just pensions, but death and service benefits as well. So it's often quite standard that people will remember to nominate a beneficiary for their pension if they were to die. But a lot of people don't realize that it's also good practice to nominate a beneficiary for death and service benefits, which would be a life insurance payout that would be paid in the event of your death. It's usually a multiple of salary, but it's always good to let trustees of the schemes know what you want to do with those proceeds should something happen to you. And then also inheritance tax. There's no inheritance tax between spouses, so it's always good to make sure that assets are structured correctly to make sure that that tax is mitigated where possible. So the way I might look at it is you wouldn't buy a house without checking its condition first, and your financial arrangements need the same care. You need to make sure that everything's structured correctly. And then the cash conundrum, so that's where it's provided a false sense of security with high rates that we're experiencing at the moment, because as it says at the top there, keeping too much cash is actually losing money over the long term. So whilst the cash rates do look attractive, it's important to note that the current high cash rates are temporary. So whilst it does seem like a quick win, it's important to note that over the longer term, inflation generally will always erode cash value. So what I've done here is show a chart which shows over the past 10 years tracking a balanced investment portfolio, so two types of medium risk balanced portfolios versus the consumer price index rate of inflation and then the Bank of England base rate. And you can see there the line at the bottom does show that interest rates have increased nicely and therefore returns on cash. However, they're not beating the average investment portfolio, which, as you can see, is volatile but has trended upwards over that 10-year period, despite the fall halfway, as you can see, the effect of COVID, and the markets did recover and, despite volatility, have done well since. So just serves as a reminder that whilst cash does look attractive, it's important that you have a good balance between liquidity and long-term growth. So making sure that you have liquidity for short-term needs, but real wealth preservation is actually made through smart investments held over the longer term. Now moving on to the core of sensible financial planning, because a structured, adaptable plan is key to your long-term financial security. So when I say core of sensible financial planning, there's a few things that you can do to make sure that your financial plan is right for you and your family. Ultimately, financial plans need to be flexible because tax rules will change, investments can fluctuate, and life happens. So it's important to make sure that your plan is always adaptable. So a key question you can ask yourself is, how resilient is my financial plan? There are several stress test goals that you can apply. So can you still afford to retire at your target age if the tax rules change, for example? Will your children's education be fully funded if costs were to rise? Just making sure that you can stress test your plan against these potential situations. And the main takeaway I'd like to say is that having regular reviews with a financial planner are essential to make sure that your plan is adapted to the changing environment. What I've shown here in the slide at the bottom is lots of people are on different stages of their life journey and you have different financial priorities along the way. So it's just making sure that everything is aligned correctly to where you're going and where you need to be. Now, in terms of education fee planning, private education is a long-term cost and planning is essential to meet that cost because school fees do continue to rise and the tax treatment of school fees could change again in future budgets potentially. So it's important to make sure you structure your investments tax efficiently. There are several ways that you can do that. You can utilize tax-advantaged wrappers such as ISAs, pensions, there's bonds, trusts, maybe grandparents are contributing towards the cost of the children's education. But then there's also a few school fee planning structures that can be used as well, using suitable tax and trusts. So it's good to consider these with a financial planner and appropriate legal advice if required to make sure that everything's structured as optimally as possible. In terms of retirement and pension planning, pensions do remain one of the most tax-efficient ways to save for your long-term future. Now, no lifetime allowance, that was introduced a couple of years ago, that was removed, which provides more flexibility in your pension planning. Now there isn't a cap, essentially, of which you can save into your pension. Expression of wish forms, as I mentioned before, are very important to make sure that you nominate your beneficiaries and ensure that you keep your pension wealth in the family. But the annual pension contribution allowance has increased to £60,000 at the current level, so by maximising those contributions is an excellent way to save taxes and make sure you plan for your financial future. The slide also shows at the bottom a reminder as to how tax relief works for pension contributions. So what I've done on the bottom left is show if you're a basic rate taxpayer making a £1,250 contribution into your pension, you would pay a net figure of £1,000, and then that's then topped up by the government with basic rate tax relief of £250. So that net cost to you is only £1,000. If you're a higher rate taxpayer, you get even more of a benefit in where you would only effectively pay £750 because not only do you get the basic rate tax relief, but also a claimed back tax relief of £250. So clearly, the net amount you pay in translates to a large grosser amount. So again, an incentive to save into a pension. You can also benefit potentially by reducing your taxable income through pension contributions and dropping yourself into a lower tax rate band as well, either from a higher rate into a basic rate, or if you have an income of over £100,000, which is starting to erode your personal allowance, pension contributions can reduce that tax rate to reclaim your personal allowance back. Now, there are many different ways of saving tax efficiently through investments, so I'll just cover a few today with you, because as we've mentioned before, high net worth individuals should be looking beyond cash savings in order to grow and preserve your wealth. And you also need to be mindful of capital gains tax planning as well, in terms of using exemptions wisely before any potential government changes are made. And diversification is key for financial planning. We always think that you should make sure you have a suitable, diversified portfolio of investments, so you're not putting too much of your money into one high area of risk, for example, that everything's diversified appropriately. So what I've shown here in the table is some alternative investments for tax efficiency and a guide to the benefits of holding them. So we've got ISAs, pensions, but then also enterprise investment schemes, seed enterprise investment schemes, and venture capital trusts. Now, as you can see from the graph there, we know that ISAs and pensions are able to be paid into quite easily. £20,000 is the annual amount you can pay into an ISA, £60,000 into a pension, as I mentioned. But what I'll focus on a bit more now is some of the lesser known wrappers of the EIS, SEIS, and VCTs, which all are able to provide income tax relief at either 30 or 50%. And the maximum annual investments can range from up to £2 million, but for the most part, it's about £200,000 for SEIS and VCTs. You do need to hold them for a minimum of either 3 or 5 years in order to qualify for that income tax relief. But the benefit of these is that some of them are able to sit outside of your estate for inheritance tax purposes, and also some ability to pay tax-free dividends as well. I won't go into these in a huge amount of detail today, but if that's something that could be interesting to you, be more than happy to have a discussion if you get in contact with us after this presentation. So turning now to legal and financial integration. As I mentioned before, we're one of the only local firms that can combine legal and financial services in-house. And that provides a unique advantage in that we can provide under one roof estate planning, trusts, tax efficiency, from both a financial and a legal perspective, providing some coordinated advice for you. And we have offices in Wells, Bath, Sherborne, and Frome. So with the presentation drawing to a close, I'd like to provide a summary and what you should do next. Please take away that the budget isn't the real issue, it's your financial plan that is. The key to financial security is action, so it's important to revisit your financial plan on a regular basis to make sure that it's still relevant and is adapted to any changes to tax or legislation. Make sure that you review your will, lasting powers of attorney, and pension beneficiaries and get those up to date. Don't rely too much on cash. Make sure you invest smartly, especially if it's for the long term. And stay tax efficient. Make sure that your assets are structured as efficiently and wisely as possible in order to try and optimize the value they provide over the long term for you and your family. So I'd like to finish by thanking you all for watching. And if you're serious about future-proofing your wealth, please contact us to book a complimentary initial meeting. And the contact details are on the slide there. You can also find us at mogersdrewett.com.